Good morning, everyone. I want to welcome you all to the 2024 annual meeting for First Financial Tax and Accounting and First Financial of Baton Rouge. And again, this is our annual meeting that we do. Most of you have been on for our previous meetings as well. And welcome any newcomers. For those of you that are not our normal clients, just a quick introduction. My name is Ameen Walker, affectionately known as the BizFixr. And I own First Financial of Baton Rouge and First Financial Tax and Accounting Service. So this meeting is set up to give my clients and anyone else who wants to listen the opportunity to hear about tax law changes for the upcoming year so that you can prepare for them, as well as general business law changes. And we always start with a little section about preparing for 2023 tax season, which is underway for the last few weeks. So let's jump right in and start with, preparing your 2023 taxes. So as I mentioned, tax season opened up on January 29th this year. We are going to go with our no extensions goal, which, we didn't have very good luck with last year because we had so many clients, but of course we've reduced the number of clients we have. So let's get back to that, make sure everybody's returns are filed on time by the deadlines so that you don't get any penalties or interest, and we're not carrying on this tax season forever, which affects our consulting season. So just make sure that you have gathered up all your documents. Don't forget, we are using TaxDome again this year, and that is our secure portal system. You should all have a log on for that. If anyone does not have a log on for that, make sure you email the office. You can just email accounting@firstfinancialbr.com, and they will be glad to set you up or send you out a password reset. Okay? If you aren't real computer savvy or you don't want to do it that way, we will accept the paperwork if you want to come and drop it off at the office, but we will not take any sensitive documents by email. That's for your protection as well as ours. Okay? We do have the tax organizer in there again for this year. Let's make sure that we fill that out. I know some of our existing clients, some of it is sort of mundane, but it's very important to get that in there so that if anything dropped out of our system from last year to this year, we can go ahead and get that updated and get it in there properly. Okay. And just want to give you all a heads up. The only other thing about last season's tax is that there is a bill working its way through the House and Senate right now. It is a bill that will increase the child tax credit by $1,600 per child, taking you from $2,000 a month to for the year to $36,000 for the year. The politicians have vowed to move it through quickly, and they will. They said in both chambers that they will pass the bill. We're just waiting for that to happen, and then of course the White House has to sign off on it. The IRS has said that they will go ahead and implement this very quickly and give it priority to get the money to you all. So the one question that someone asked me who found out about it is, do we have to wait to prepare our returns? And the answer to that is no. You will prepare your returns just like normal. You can do them now. And once the bill passes, the IRS will automatically send you a check, or if you had direct deposit of your refund, they will send you a direct deposit of that $1,600 per child automatically, just like they did with the CARES Act that happened a few years ago when you got those extra child credits. Okay, so that's really it for last year. Let's just, like I said, get on it, get over and get done. And we're halfway through the business filing time frame that ends March 15th, and your federal tax returns need to be done by the middle of April. Okay. So let's move on now. We're going to talk about some tax law changes for 2024. And this is really the crux of why we do this meeting. We want to do it early enough in the year so that you can prepare throughout the year. It's too late to get this information at the end of the year. So let's talk about it. Estimated tax payments is the first thing I want to cover. And every year, your tax return from us, if you're not our client, I can't vouch for your tax preparer or CPA, but every year, our tax return includes estimated tax vouchers for the following year. So it's important that you send in those estimated tax payments. The IRS expects you to send in about 90% of the taxes that you owe. And if you don't, they will charge you a penalty, which is an underpayment penalty of 5% per month. So it's pretty expensive. That also penalty takes effect if you file an extension, because an extension is an extension time to file, not an extension time to pay your taxes that you owe. And so, the craziest thing about that is you can sit here and figure out about how much you owe, but if you're doing that, you can probably prepare your tax returns, right? So, let's make sure that you send those in, not do the extension, and make sure that this year, each quarter, you send in those estimated tax payments, because we can only get those penalties waived once or twice. Okay? The second thing is that the IRS is going to begin issuing some collection notices that were stopped. During the pandemic, they stopped sending out bills for 2020, 2021, and that stopped in 2022. Some people think, oh, I'm not responsible for those debts anymore. You absolutely are. But now they're going to start sending out those automated notices again. So if you get an old notice, you need to get it to us. Let's figure out what's going on so you can get that paid. Next, the IRS is providing about $1 billion in penalty relief for what they estimate to be 5 million tax returns that were filed by 4.7 million individuals. They include businesses, trusts, estates, and other tax-exempt organizations, but the bulk will be for individuals. And most of those will be receiving an automatic penalty relief if you make under $400,000 a year. What I mean by this is, let's say in 2020 or 2021 or 2022, you paid your taxes late and you were assessed this late filing penalty or even an underpayment penalty. If your annual income is under $400,000, the IRS is most likely going to be forgiving that. Now, I just mentioned previously that you're going to receive some notices in the mail automatically on these collections. Do not count on them waiving those penalties automatically for you. My recommendation is you pay those collection notices that you have or continue to make payments on them. And when they actually do waive your penalty, they will send you a refund. But if you ignore those notices, counting on this tax relief, this automatic tax relief that they're getting ready to do, you don't want to get caught in an instance where they don't give it to you for whatever reason. Maybe they reach their cap on how much they can give out, but they don't give it to you. And then now you owe more penalty because you didn't pay it on time. So if you get a notice, my recommendation is to pay it or to call and set up some payment plans, start those payment plans. And then if you get the relief, they'll send you a refund. Okay? The next thing we're talking about is every year I do a seminar that's given by the IRS, which talks about, different types of things that, that have been issues on tax returns. And I will tell you the biggest one that seems they're going to crack down on this year is mileage abuse. So we all know when we have a business, whether we're a Schedule C or whatever type of business, we can write off mileage that we use for business purposes throughout the year. The only problem is if you get audited, that requires you to provide a log that shows the date you traveled, where you left, like what address you left from, what address you went to, the purpose of the trip, whether it was business or personal. And, it doesn't even hurt to put a client's name, but, they don't really require that. So if you get audited and they question your miles, they're going to expect to see a log with all of those thousands and thousands of miles you all did. It can get very tedious. It can get very difficult to do. It's easy to forget to do it. So my recommendation is you go online or go into your app store on your phone. And there are several. I use Mile IQ. It's I think I actually put in the book Miles IQ, but I think it's Mile IQ, which is MILE IQ. And that is an app that will automatically track your miles. And then at the end of the whatever period you want to use, I use weekly. So on Sundays, if I'm watching TV, I'll sit there on my app and I swipe right if it's business, I swipe left if it's personal. You can set up rules for common things. For instance, when you travel from your home to your office, that is considered commuting miles and that is not deductible. If you travel from your home to a client's office and then travel from your client's office to your office, both legs of that trip are then deductible. But whenever you go straight from your office, your home to home or home to office, then you have an issue. Okay, so you do not want to have to get caught in a situation where you're accidentally, swiping right or left. So my app that I use, Mile IQ, allows you to actually set up a rule that says, if you see me leave from 1420, my address, to 5431, my address, recognize that as commuting miles and automatically make it personal. Okay, so you can also set it up to say, between organizations, between offices, there's no limit to how many rules you can set up. And the more rules you set up, the easier it makes that job for you each week or every day. I have one client that does it every evening because it takes them about 3 or 4 minutes to do it. I spend about an hour on Sundays doing it. Okay? There was a law supposed to take effect again to January 1 this year. It was actually supposed to take effect last year, January 1, and they delayed it to this year, and they have delayed it again, and that's the K-99 threshold law. And what that says is if you take credit cards or you send money electronically through Venmo or Cash App or any one of those type of systems, if you send or receive more than $20,000, then you are supposed to receive a 1099-K, which lists how much money per month was sent through that system. Well, they passed a law a few years ago. Again, it was supposed to take effect last year in January, which said if you do more than $600, you would get a K-1, and that K-1 must be reported on your tax return, whether you're an individual or any type of business. But that's very cumbersome. $600. Almost all of us probably send more than $600 worth of Venmos. So I think what's happening is they're really trying to figure out how they can even administer this, because there would be hundreds and hundreds of millions of these K-1s going out every year, and they're just not equipped to do it. If I had to guess, I'd say they'd probably go ahead and drop it. The law was passed by the current administration. If it switches to another administration, I'm sure they'll drop it. I think even probably the current administration will drop it at some point soon. Okay. For 2021 and 2022 tax year, for those of you with businesses, the meal deduction was 100%, regardless of what type of meal it was that you paid for the business. That for 2023 went back to the old method, which is 50% for certain types of business meals and 100% for other type of meals. And that has stayed in effect for this year coming up. So let me give you a quick recap. Owner's meals are never deductible. If you stop at McDonald's and grab yourself some breakfast, you stop at Starbucks and grab yourself some coffee, those type of meals, you go to lunch by yourself, those meals are not deductible unless you are on business and more than 75 miles from your home. So we're in Baton Rouge. So for instance, somebody goes to New Orleans for a training class for the day and it's just the owner of the business, they can go have lunch and that meal is deductible. At that point, it becomes what's known as a travel meal. Okay. Now, for any meal that you take, let's say you take a client to lunch or you take a prospective client to lunch, that meal is 50% deductible. And, somebody asked me one time, well, why is it 50% deductible? Well, if you remember, I just said the owner's meal is not deductible. So the assumption is you and somebody else are going to lunch, their meal is deductible and your meal is not deductible. They didn't want to get into who's eating what, who's having what appetizers, what meals. So they just said, we're going to make it 50%. Now, of course, that works to your detriment if you go to lunch and take 4 people to lunch, because of the 5 people, only half of the meal is going to be deductible. Okay? But that is the way that is. There are times when meals are 100% deductible. If your people are working in your office and you don't want them to leave because you're under deadlines and you order food for them to be able to eat, everybody to be able to eat at their desks and not leave, that's called a meal for the convenience of the employer, and that's going to be 100% deductible. So let's make sure we understand what type of meals are deductible and which are not. Another type of meal that's 100% deductible is if you go for a special event, a special occasion. Let's say you decide to have an office party and you're going out to lunch for that office party, or you're bringing food in for that office party, whether it's the end of the year because you did really well, or you have a standard thing that you do a birthday lunch for your people. Those meals are deductible 100% under one condition. Everyone in the office must be invited. It doesn't matter if they come or not, but everybody must be invited for that to be 100% deductible. So if you want to have those, that's fine. Just remember to make them open for everyone there. Other than that, the meals, if you buy donuts and things like that for the office, those typically will go under office expense anyway, so those will be 100% deductible as well. Okay? So let's move on to some of the basic changes that happen. So, every year, pretty much the IRS increases your standard and deduction, whether you file as a single person, head of household. It's called an inflation, and an inflation increase, but it doesn't follow inflation because it's actually usually more. So let me give you an idea. This year, the standard deduction has increased to $14,600, and that's up $750 from last year. Married filing joint is up $29,200, and that is up a total of $1,500 from last year. And head of household is $21,900, and that's up $1,100. If your itemized deductions are more than that, of course, we're going to use those. But the standard deduction, the idea was this is part of the what they affectionately call the Trump plan of 2018, which said we're going to raise the standard deduction. We're going to get rid of the personal exemptions and some other things so that more people file a standard deduction and don't try to cheat on itemized deductions. So keep in mind, after 2026, this goes away and we go back to the old plan. So we got a couple more years of this going on. Okay. Marginal rate tax rates have also increased. That very few of you deal with marginal tax rates, so I'm really not going to go into it. But if you know what that is, then it's something you have. Right? The estate tax, which is also affectionately known as the inheritance tax generally, that level has increased to $13,610,000. So if someone passes away and you inherit money, you do not need to claim it unless you're over those dollar amounts. The annual gift tax exclusion has gone up to $18,000, as well as the adoption credit has increased to $16,810. So those are the basic changes with regard to standard deductions versus itemized deductions. Of course, you prefer standard deductions because you don't have to keep receipts as you do with your itemized deductions. Okay. So we're going to move on now and kind of shift gears a little bit, still talking about a credit, but we're going to move on to the EV credit, which you'll see here. Let's talk a little bit about that because EVs are getting more and more popular. I just bought an electric vehicle myself, and so I want to talk about this. So the electric vehicle is limited with several restrictions now. It was more generous in prior years. This year, starting in 2024, there are a lot of restrictions with it. So you can get up to a $7,500 credit on new vehicles. You can get up to a $4,000 credit on used vehicles. Now, they do have limits on the cars that qualify for these. So I'm not going to sit and read this list. You can refer back to it at the end of the meeting, but these are the only models that qualify for electric car credits in 2024. Some of the other restrictions you need to keep in mind is that your trucks and SUVs have to have an MSRP under $80,000 as a base price, and then they can have installed options on them. Maybe they have a comfort and convenience package or some kind of special entertainment package that raises it, but the base MSRP has to be $80,000 or less. Moving on from there, We're going to, there are some other restrictions on modified adjusted gross income that makes a difference on your, on these things. And you can see on the next page of my slide that there are restrictions such as on a new EV. And I'm sorry, I just realized I did not put a page on this, so we can stay where we are, but just don't go ahead. There are restrictions on modified gross income. So new EVs for single and married filing separately, you have a income limit, an a modified adjusted gross income limit of $150,000. A head of household is $225,000, and married filing jointly is $300,000. And those go down in half if you're buying a used vehicle. In other words, for single and married filing, single filing separately, I mentioned it's $150,000. For a used EV, it goes down to $75,000. And the key there was that they really wanted to, they want to make this credit available, but for people who really need the credit. Okay? So you can use the credit though now, which is nice in two different ways. Prior to this, you had to use it on your tax return. You claimed the credit right there. Now you can use it in the dealership as a reduction of selling price, much like a manufacturer's rebate is used. And that's actually a better deal because it's a one-to-one credit. You also save on your taxes for registering the vehicle if you do it that way. And you don't have to worry about it getting rejected as part of your tax return. And it's an immediate benefit. Okay. So those are really all of the, the major law changes having to do with taxes for this year. There really aren't a lot. It's probably due to the fact that people are campaigning and politicians are worried about the war and everything else. So they didn't really put a whole lot into effect for this year. So now what I'd like to spend a section to talk about the general business law changes that are going on. And, again, you should check with your own attorney on this. Some of these are interpretations. You can read on them more than this information that I'm giving you. I will mention this now and I'll mention it again at the end. There's going to be an FAQ email given to you at the end, and we're going to allow you to go ahead and email me some questions that you have regarding any of this information or anything else that has to do with these two subjects. And in a week's time, I'm going to come back with a second Zoom that will just answer the FAQs. I encourage you to get back on it because maybe someone asked something that you didn't know. So this is the big one right now. And you've probably heard about it, and there's so much misinformation going on about it. I'm going to tell you what is my opinion on a few things with it. I'm going to state what the law actually says, but I'm going to let you know, how I'm advising my clients, and you can make your choices from there. I had somebody call me the other day. It was actually one of my clients, and said, I need to change my company to a C corporation because of this new law. And I said, wait, what are you talking about? And they said, I don't know. There's some law out that says, I have to tell the government all kinds of stuff I want to tell them, but I don't have to tell them if I'm a C corp. So what they're talking about is absolutely incorrect. So let's just get that straight from the beginning. Do not change. I'm telling my clients, do not change from an LLC. Even if you are an LLC taxing as an S corp, it is not in most cases beneficial to change to a C corporation. Again, check with your own CPA, your tax preparer, your tax attorney, and ask them their opinion on it. But I'm telling you what I tell my clients. And that's that typically the best legal structure for you to give you the most protection is the limited liability company. That's exactly why it's called that. It limits the liability you have in the company. Okay, so let's talk about this. This is a new law. It is put out by FinCen, and FinCen stands for the Financial Crimes Enforcement Network. And there is something that you have to do. It is called a Beneficial Owners Information Report, also known as a BOI. If I say BOI or you see BOI, that's what people are talking about. So this is, as I said, it went into effect January 1, and we'll talk about it later, but there are some serious major penalties that you will have to face if you do not abide by this. The background on the law is that it was developed and designed because there are too many people that are operating through shell companies. So this law, it was put into effect that says you have to disclose anyone who benefits from your company financially because, or even through gratis work, or maybe you give them free services, bartering work that you do for them. And you have to tell them this whether or not they are on the company with you as an owner. Some of you have a company where somebody invested and they're a silent investor. They're not on the Secretary of State's company with you. They're not on a tax return with you. But once you determine your profit, you give them some money, or you pay them a monthly amount that's set up. You have to disclose them as well. And when you disclose, you have to give all personal information. So let me give you an example of what you have to give. You have to give it in all parties, and you have to give their names, their addresses, and not their business addresses. Like, sometimes on Secretary of State's, we'll put the member's address as the business address because that's public information. And we don't want to put people's home addresses there. They don't need to be there, right? But you need to put you'll have to give them your home address. You have to give them the date of birth and a social security number. And you have to upload supporting documentation. You have to upload a driver's license or a passport. There are a few other types of things that you can put. In some instances, you'll have to upload the articles of formation, depending on what type of business you are and what state you're in. So you have to basically give them everything. Now, someone asked me, can I do this myself? You can try that, absolutely. I think there are parts in there that are going to confuse you if you're not used to doing these type of things. For instance, you must establish a FinCen filing number in order to do it. And most people don't know how to establish that FinCen filing number. There are places out there that are doing it, okay? We'll talk a little bit about that later. Now, who has to file, or when do you have to file? So if your business was established prior to January 1st, 2024, you must register your business with FinCen doing this BOI report by December 31st of this year. Okay, that's your deadline. If your business was started January 1st of this year or later, you must register your business within 90 days. So if you registered your business January 2nd, you've got about another 30 days to register your company. Otherwise, you're going to be late. Okay. And to answer the question of who must file, most businesses have to file. There are 23 exceptions to this rule. There are some, you'll need to go individually talk to, again, whoever's doing this for you, your attorney, your CPA, your paid tax preparer, whoever's doing it for you, you need to talk to them about whether you are exempted. Most cases, you are not exempted. So a few of the exemptions that are kind of commonplace businesses are investment advisors, people that, help you with your 401k and they invest your money in IRAs. They're excluded. Insurance companies are excluded. Accounting firms, and not just any accounting firms, it has to be a public accounting firm, is exempt. Now, those three are exempt for a specific reason. Those three are exempt because they already have to provide all this information for their licensing boards, and their licensing boards have to provide this information already to the federal government. So that's why they're exempted from it. The only two types of businesses other than that are pretty common, or might be more common, that are exempted is if you have a tax exempt organization. My wife and my organization, that's Walker Morgan Help for the Homeless, is exempted from reporting this information as well. Again, because there are no tax ramifications to the tax exempt organization. So there's no reason that a tax organization is even setting up shell companies. The other one that is exempted is large operating companies. Now, personally, I think they should have said large operating companies that are publicly traded. Okay, because publicly traded companies are monitored by the SEC. They have very strict and stringent reporting requirements. They have to already disclose all this information. I think that's what they meant to say, but I don't know whether they're trying to pass the law too quickly or they just left it out on purpose. But for them, a large operating company is defined as somebody with 20 employees or more operating an office in the United States and on their previous tax return filed over $5 million worth of revenue. So you have to have all three of those. Any one of those does not exempt you from it. But if you fall into that, which you're my client, so I know several of you do fall into it, you will be exempted from having to do this filing. But don't forget, this is not a group, and this is not what they call arm's length transactions. In other words, I own several companies. My other companies are considered arm's length because they have the same characteristics. My wife and I own those companies. Someone else owns those companies. You own the same company, or you're the same ownership as the company down the road, right? They have to each stand on their own. In this case, it is not like the arm's length transaction exceptions rules. So we have to, even if you have 3 companies and between them you have 20 employees, operate all of them in the US, and between them you have $5 million total, you are not exempted. Each one still needs to file, okay? So registration can be done by you, and I'm not sure if I remember to put the link on the form on here, but it is at https://boi efiling.fincen.gov. So I will make sure that if we put that into the information from the FAQs, but you can just Google FinCen, which is FINCEN, and BOI filing, and it will come up, okay? Now, it's very important. I mentioned you can do this on your own, but it's very important that you report all of the data and the information correctly. So there is no penalty if you file incorrectly and you correct it within 90 days of when you originally filed it. But if you file it incorrectly and you do not correct it, it carries a penalty of $500 per day until it's corrected. And you can also be fined up to an additional $10,000 and or face up to 2 years in jail. Now, I think the jail time penalty that they're talking about will be cases of blatant disregard for the law, either not filing or filing something incorrectly because you're going to certify that to the best of your knowledge, this information is true and correct. Then you do that when you know that you've lied about something and they catch you. But, you know, in general, even if not, even if it's just an oversight, you are still subject to the $500 a day penalty. So it's going to get really, really costly. I always use an example, you know, a $500 penalty to most businesses doesn't mean that you are going to have to sell $500 to make that $500 up, because you have operating expenses, you have supply costs or material costs, you have labor hours you have to pay. So if you're operating at a 10% profit margin and you get a one-day penalty of $500, you're going to have to sell $5,000 worth of sales to make up for that $500. Now multiply that by 10 or 100. If you're 3 months late, you are now going to have to do $500,000 worth of sales to make up for the penalty. So let's just get it done. Okay, now, for those of you that don't want to file separately, and these things are coming in the mail, I'm just going to tell you, be careful. There are many companies sending out letters now in the mail saying, and they look very official, and they're saying, you know, that they cite that this is a new law and that you have to file. And they basically act like they are the government or an authorized representative to do this information for you. You can use them, but you need to keep in mind that you don't even know who these people are. This is a letter you got in the mail. So not only are you about to pay them, most of them seem to be charging around $300, some a little bit more, some a lot less, which is something you really need to be careful about. But not only are you going to pay them this $300 to do it, but you have to give them your name, your social, your address, your company information, your date of birth. You're going to give them a copy of your driver's license or your passport. Do not do it with anybody over the mail. I'm telling you. And after the mail, you're going to start getting the phone calls, and they're going to sound very official. Okay. Um, I don't know who you all use. Obviously, for my people, I'm going to recommend that they do it with us. First Financial is preparing them for $250. We will prepare them for non-clients as well. But again, if you do that and you want us to prepare them for you, we are going to want to put face to you. In other words, we're going to want you to come to our office and meet one of the people in our office to do this, or I know we have some people that are out of state and they might refer you and you live out of state. We're going to, at the minimal, want to do a Zoom with you. We're going to want you to hold up your ID or something to verify who you are, and you to see who we are, so that you know that you can trust us to do this for you. But just, find somebody that's reputable to do it, because you're giving them all your personal information. Now, I know I have one client that said, I don't want to give them any of this stuff. I don't want to give them the information. It's none of their business. The truth of the matter is, they already have it in one way or the other. You fill out your tax returns, that has your date of birth, it has your social, it has your address, it has all of that information. The people that are hiding the information are the people that are trying to hide through shell companies and things like that. But if you operate your business like a normal, respectable person, chances are they have all this information anyway. So just give them the information so you don't get the fines, and we'll move on. Okay. Moving on from here, at the last thing on that slide was that all banks are now also required to report demographic information on all borrowers, which includes your sex, age, race, ethnicity. And these things were all covered under the Dodd-Frank Act from years ago. This act is 25, 30 years old. And up until now, it's been voluntary. When you fill out an application, you see that box and it says optional information, and you can mark those things off. That's the Dodd-Frank Act. But now these things are actually going to be required to be gotten from the banks. So it won't say optional anymore. You're going to need to provide it. And there are a lot of reasons why I don't really want to go into that, because it plays into politics. Okay. Next, all businesses must comply with the Gramm-Leach-Bliley Act. Again, this act is over 30 years old. And this says you have to maintain the privacy of your customers. Now, what does that mean? Privacy is defined as having available to someone else another person's information that is deemed to be private, and it's two or more of those private pieces of information together at the same time. So what do I mean by that? If I have something on my desk that says my name and 123 Main Street, Baton Rouge, Louisiana, 70816. Well, that's two pieces of information, right? That's my name and that's my address. But if my name is listed, I can't say in the white pages or yellow pages anymore, but if my name is listed online and it's common knowledge, or I put it online with some other method, then those two pieces of information do not violate the privacy. Okay. But if I have my name and I have my date of birth, and somebody's sitting across the desk and they can read it, they can see two pieces of my information. Now, I know I said the name is not private, but it's when you can link two things together. Okay. And they're, only one of them needs to be private information. So in the first instance, I told you the name and the address both can be found online. In the second case, the name and my date of birth are not commonly known, even though they might appear online through, those crazy do background checks on people and stuff like that. If it's not common knowledge, then it can't be known. So that's why when some of y'all come to my office, before I come and get you, and why we don't let you just walk back here, and Brenda says, no, you can't go back there, I need to go tell him. It's because I probably got things on my desk. I probably got something up on my screen that I want to minimize before you walk in and see somebody else's private information. This could be a name and a telephone number if the telephone number is not listed. It can be name and social. It could be social and date of birth with name. So it can be a lot of different things together. Okay, so please make sure that you're complying with this. One little known fact about the Gramm-Leach-Bliley Act that people do not know is if you own a business and that business is responsible for having somebody else's private information, you have to use vendors and you have to have your vendors sign a statement that says they know that there might be private information in that vehicle. Like, maybe this was too convoluted. Let me just give you an example. Let's say I own a car dealership and a customer brings in a car to me that they just bought. And the agreement was bring it back to us, leave it with us. We're going to send it out to a shop to get the windows tinted. The customer comes and brings you that car. That car in the glove box might have their name and their address. It might have their purchase paperwork in the glove box. And now you take that car over to your tinting company, and the tinting company now has access to that information. You have to have on file a form signed by your tinting company saying that they will comply with the Gramm-Leach-Bliley Act and they understand that it's their responsibility to keep the customer's information private. Little known part of that rule, but it's an extra step, but you need to do it, okay? Now, the last couple of things we're going to talk about is overtime exemption limits have changed in some states. They have not, it has not changed yet as a federal rule, but it is expected to change. So this raises the income level for a waiver of overtime. And what I mean by that is you put somebody on salary and you do that because you want to avoid paying them overtime. Well, in the past, most people think the limit was $35,568 a year, which is $684 a week. So a restaurant would put one of its employees on a salary of $700 a week so that they don't have to pay them overtime, okay? The problem with that is that law is affectionately known as the white collar exemption rule or high earners salary rule. So what that means, it was always $420 a week since its inception. And then after about 40 years during the Obama administration, it raised to $684. So what that means is you cannot pay a cashier $700 a week just to avoid paying them overtime. If you pay them salary and they go over 40 hours, you still have to pay them overtime. So you take their salary divided by 40, gives you an hourly rate, and then you have to pay them time and a half over that salary amount that you already paid them. And you're also stuck in a jam because guess what? If they miss a day of work or they miss 2 days of work this week, because they're salaried, you are not allowed to dock them for that time that they missed. Or tell them you're going to make it up later with overtime and take that away from them. It's week by week, week by week. And because you agreed to give them a salary, it's not based on hours. But because they're not a manager, if you have an assistant manager at a restaurant, a manager, a general manager, you can salary them all day long because they supervise people. And that's sort of the guideline for that second half of it. So if you pay somebody that's a manager $700 a week and they work 50 hours, you do not have to pay them overtime. But again, if they miss 2 days, you cannot dock them. You still need to pay them the $700. So keep that in mind. Now, the new threshold that they're expecting to pass is going up to $55,068, which is $1,059 a week. So if you're paying somebody's salary now, you're going to have to make a decision if you're going to keep them on salary, keep them where they're being paid, and pay them overtime if they're not making $1,059 a month salary, or make a decision of whether you're going to take them completely off salary and start paying them an hourly rate, or if you're going to raise their salary to $1,059 a week so that you can satisfy the overtime rule. Okay, so that's what you need to do, what you need to determine, and a decision you're going to have to make because this law is going to pass relatively quickly. okay? And so if you have any questions on the overtime rule, this is not a rule that a lot of attorneys even know. You can go to the www.dol.gov and there's information on there about it. Certainly if you're my client, you're welcome to call me or, or shoot me an email, and I'll be glad to answer additional questions on that. If you're not my client, you're welcome to go ahead and send the FAQ, and we'll be glad, we'll be happy to answer those. The last thing is along this line of employment law changes. Several states have increased or set new minimum wage requirements. There are 28 states that have income requirements that are above the federal level. So you need to be careful. For instance, I know somebody's on here that is in California. You're going to be listening to this. That's in California. Fast food workers there now have a $20 per hour minimum wage that took effect. So, and it took effect January 1. So if you're not paying your fast food workers and you have a restaurant in California, you have to go back and retroactively pay them for the difference and then start paying them for the $20 an hour now. So please just Google minimum wage in Louisiana or minimum wage in Florida, and that will pull up what your minimum wage is and make sure that you're complying with that. Additionally, some states now require sick pay. California requires that you give your employees 5 days of sick time, but it does not require you to pay for that. It just says you have to make that available to them. I don't know really what that means, different than when somebody calls out sick now when you don't have the rule, but it has to be, be part of your policy. Some states like Illinois have 5 days sick pay that you have to pay an employee. So you'll need to start making some decisions. Maybe if you give somebody a week or two of vacation and you have to give them 5 sick days, now you're not giving them 5 or 10 days, you're giving them 10 or 15 days. So maybe you'll adjust that, that there's nothing that says you can't adjust your other policies or some of your other benefits that you offer to your employees. But if you want to avoid the trouble, I'm going to tell you now, you need to have an employee handbook. If you don't have an employee handbook, you are going to get hit with hundreds of $1,000s worth of fines in a lawsuit that you get. You will get hit with fines from the government on issues like this. And these are exactly the kinds of things that need to be in your handbook. Find somebody that's reasonably priced to do it. Don't do it yourself. I mean, I hear that all the time. I'm doing a handbook right now myself. Yeah, how long you been working on that? For a year. It's not worth your time. Don't get it online because it's not going to be specific to your state. I know they're going to say 50 state compliant, but I can tell you this, if you're in Louisiana, there is nothing that's 50 state compliant. So we are Napoleonic law here, and so everything is different. Find somebody that's experienced, a consultant and a law firm, somebody, that does employment law. First Financial writes them starting at about $350 a month for a basic handbook. So you don't have to pay a lot of money to get it done, but it can cost you hundreds of thousands of dollars if you don't get it done. So things like this, your minimum wage, your salary requirements, all those things need to be in that handbook. There are several things that need to be in your handbook that I know are not on one. I went ahead and spent $109 on one that was online just because I wanted to see. That was like the most expensive one I could find, and it had nothing about the American Disabilities Act, which is not a law that's recent, but a law that went into effect a couple of years ago, meaning you had to put it in your handbook. Also, the other big one that we see a lot is that the sexual harassment and racial discrimination sections are not nearly compliant enough. I can tell you, if you have a handbook and your section on racial discrimination or sexual harassment is one paragraph or even one page, then it's not enough to cover you. So you might want to evaluate that and visit it. Okay, so that brings us really to the end of the information. Again, I want to repeat, here is the link for you to send an email to us with any questions you have, either on information that was covered or information that was not covered. It is FAQ@firstfinancialbr.com. And I want to thank you all for taking this 50 minutes or so to sit on the call. You can find us on various social media sites, although I can tell you, so we don't work anymore through that system a whole lot. So, but there's plenty of good information on there from the past. And I do still post sort of recently. This will be posted on the YouTube page, which if you go to YouTube and you look up First Financial of Baton Rouge, our page will come up and this information will be there for you. A phone number and fax number are also on here should you choose to do that. And again, thank you for the convenience of coming on here, the inconvenience of stepping away from your jobs and your employment and your companies for that long. Okay, thank you. Have a good day.